It's September 27th, 2023, and today is the Think Tank Exchange focused on small caps with Matthew Bartolini and Bryan Novak. Thank you, State Street, for sponsoring the event. The disclosures are also in there just to make sure everybody knows, as well as the bios, because it's always good to know who you're talking to. I'd say about 2 weeks ago, I wrote a piece called Structure Matters, Small Cap Zingers, and I hope everybody will take a look at it. Small caps at the end of the day, whether it's the small business down the street or small caps in ETFs, are at the core of the economy, whether we like it or not, right? I point out that, let's say, small businesses account for 64% of new jobs. 99.9%, believe it or not, of businesses in the US are small businesses. And that, it's all relative, right? A small business can be one person, 5 person, or 100 people. There are 32.5 million small businesses in the US. All this, I think, points out to how important the capital markets, whether it's your bank down the street or the capital markets that we deal with, meaning the ETF business, that they're open and liquid. My last comment, and then I'll introduce my guests. Listen, today, small caps are about $323 billion, or about 4% of the ETF market. Maybe they should be bigger. Maybe they should be smaller. But we'll have that debate today. So with that, I'm going to start in, and Matt, maybe you go first and just give your background. I think a lot of people know you or on this call, but just in case somebody on X or Twitter doesn't know you, go for it.
Yeah, so I'm Matthew Bartolini, head of Spider America's research at State Street Global Advisors. I run a team of analysts and strategists that help, advisors and clients make sense of the unique world that we live in, using different data and analytics, providing market commentary, whether it's around flows, positioning, our chart pack that comes out on a monthly basis. And we try to really help sort of guide investors to help make those really hard decisions around portfolio construction.
Bryan, go for it.
Sure. Thanks, Dan. So Bryan Novak, I'm a portfolio manager, one of the partners at Asser Investment Management out of Chicago. So been here for 22 years, buying and selling ETFs. So we're an asset allocator. So our job is on the other side of this. We're buying things. So this is a good discussion as we look at, small caps, large caps, et cetera. This topic has come up quite a bit in the last couple months, years, and it's got some mixed results, but it's definitely one to delve into because it is a big part of asset allocation models. But yeah, so that's my job. I do a lot of the digging into the different ETFs and what's out there. It's become a little hard to keep track of with all the issuers that have come up this year. Different conversation. Prior to joining Asser, I was a derivatives trader at the CBOE in Chicago. So that's a little bit about me, and we'll get into it.
Yeah. So, Matt, you put out this white paper and you highlighted 2 or 3 different benchmarks and the key differences between them. So I figured we'd just start the discussion and, around your paper, and then we'll talk about, how structure matters for at least 4 hours. Kidding. Sorry. You could have laughed. But
That's
anyway,
nice.
yeah. So anyway, you can see, I think you can see your slides. Is that fair? Cool.
Yeah, so the paper was really just trying to discuss the impacts of index construction, particularly in more nuanced spaces like small caps. And this can really also extend to different areas like emerging markets, different parts of international benchmarks, where they're looking at Europe versus Eurozone. Some of these decision choices around the construction can really have significant impacts. And one of those is just between the S&P 600 and then the Russell 2000, but also you can make the connection versus the CRSP indices as well. And small caps as a segment, they sort of get grouped together, but the way you actually construct those benchmarks can have particularly meaningful divergences in returns. And as you can see on the slide here, that since 1994, which is a long time period, S&P 600, so still small caps, outperformed Russell 2000, which are small caps, by 676%. It's about 1.5 or 1.8% per annum, and that's some significant returns. And something that we showcase in the paper is this is not by accident; it's actually by design. The design of the index focuses on a smaller segment of the U.S. equity market, and also has a profitability screen due to the financial materiality within the broader S&P 1500, which the 600 sits at the bottom of that stack. So focusing on smaller and more profitable firms are two factor premia that in academic terms have been really rewarded. So if you have a heightened exposure to those two, that has added incremental returns over a long time period that we can see not only on just this periodic basis, but on a rolling basis that has persistency and consistency. And it's just a result of the index design choices, which are foundational. So this is something that we write about on my team. We're sort of doing that introduction around, what we do, portfolio construction topics, thought leadership, education, just trying to sort of strike through the noise and sort of understand, why does one asset outperform the other? And are there biases? Is it persistent? And what we found is with S&P 600, is a pretty strong track record of outperforming other small cap benchmarks because it anchors in on two factor premium more so than the other benchmarks. And those factor premium are small and more profitable small cap firms.
So I'm just going to go through like the 7 key or 8 key slides to emphasize your point, and then we'll get into a discussion around them.
Yeah. So
and Brian, feel free to chime in anytime.
So this is a great slide just to showcase the small nature of it, right? So S&P 600 covers the bottom 3% of the market, 2000 is 7%, and then the CRSP is 13%. And you can see the average market capitalization is far lower when you get into the 600 because it's going to be covering a smaller portion of the marketplace. And on the next slide, what we can look at is just some of the gaps and overlaps. This is another thing we talk about. Because of the actual strict bandings within the S&P framework, you have a 400, a 500, and a 600. Those are pretty hard barriers, and there's no mix between them, so you don't have any overlaps. When you start to mix in other benchmarks, you start to have this sort of bleed through. Within the CRSP small cap benchmark, there's 57% that are also in the Russell mid cap. So you start to have sort of an overlap issue. But we stick within that S&P space, you have a pretty hard barriers where you actually, you get large caps, you get mid caps, you get small caps, and you have this no gaps and overlaps type feel to it. So again, these index design choices can have a material impact. And I know I don't want to walk through every slide, but I think on the next one, we can start to sort of crystallize what I was referring to about factor premia. So one of the things that we did in the article is look at returns and regress them versus the Fama-French coefficients to identify, is there a stronger relationship to small minus big, which is your size factor? And there is, right? It's not, they're similar in nature, but you do have a stronger factor coefficient within the S&P 600. The one that I think is the most interesting, and there is statistical significance in this, is when we look at robust minus weak, which is your sort of quality factor. Robust minus weak for CRSP and Russell are negative, and those have statistical significance that, those are unprofitable or sort of unquality like firms. But the S&P 600, because the financial materiality or viability requirement within the index design has a positive factor loading. And I think this is what has led to that sort of persistent and consistent excess relative returns for an S&P 600 benchmark versus Russell 2000 or CRSP or some other funds, not funds, but other indices out there as well.
Yeah, I think this is interesting. Sorry, Dan, that because you mentioned the Fama-French coefficients, and I think over the last few years, like it feels like some allocators have maybe lost a little faith on that side of things, especially value. But you look at the size component of it, and when people and allocators start to distill down sort of what they're looking at and getting contribution from that, it's been a little hit or miss, right? But I think that what your slides and discussion on the benchmark really boils it down to is sort of when you get myopically focused on a particular benchmark, it can keep you in a particular silo where you can miss the opportunity set maybe in how another benchmark is slicing, dicing them into this. Because I think a lot of people would be surprised by the difference in returns and persistence between the S&P benchmark versus something like Russell, where a lot of people get focused on that particular benchmark.
Yeah, and what I think is really interesting is, and I said I didn't want to go through all the slides, but I sort of love all my charts equally. On the next slide, we use the risk model in this case, right? So one aspect of the analysis was doing historical return regressions versus factor coefficients. We use the Bloomberg risk model on current holdings to say, okay, well, what does it look like now? Do these benchmarks have a different factor exposures? And we see here on the blue bar, the S&P 600 relative to the Russell 2000, the profitability factor has a positive coefficient to it, right? So this means the S&P 600 relative to the Russell 2000 has a stronger profitability profile. And also, same thing versus CRSP. It's not as severe, but then we look at the size factor. Again, these are the two things we really want to hone in on. Well, on the size factor, there's a significant bias towards lower size on S&P 600 relative to CRSP. And this just goes back to, the earlier slides on the construction. 3% of the US equity market is covered by the S&P 600. 13% is by CRSP. And I think that really goes to show you that sort of tightness on the size factor. But because of that financial viability, you also then get profitability coming into it, because firms have to have 4 consecutive quarters of positive earnings growth. Positive earnings per share. And that's going to wean out something that's been kind of a problem for small caps, is the zombie companies, these companies that don't earn anything. They're not profitable. They're just burning cash. And I think that's one of the reasons, from a markets context, over the last, 18 months, really since the Fed has been amping up real rates, these unprofitable companies have done poorly. And that's why you've seen such a massive divergence between a small cap benchmark that maybe focuses on profitability and one that doesn't, because companies in a negative real rate environment that are unprofitable but have these lofty growth expectations, that actually probably is not a bad idea to invest in. I'm not saying it's a good idea, but I'm just saying the opportunity cost of investing your money at a real rate when it's negative, you're going to get a negative real return. If you're investing in a company that burns cash, has a negative cash burn rate, well, your cash flow returns the same, but your forward-looking growth prospects are much higher. So maybe you can sort of stomach the negative cash return. But when real rates are positive, that opportunity cost math changes. And that's why these unprofitable firms have really had a hard time. And that's why you've seen this divergence. One of the things I think is interesting is that if you go back to 1994, you can say, like, why would I own small caps? If I look at the S&P 500 versus the Russell 2000, large caps beat it handedly. Small cap premium doesn't exist. Can't get it in the Russell 2000. But if you look at it versus the S&P 600, S&P 600 outperforms the S&P 500, because again, academics have shown that if you sort of control for profitability, if you control for this quality nature, the size factor can actually be quite a stronger premium associated with it. And I think this slide just says it all, right? So we looked at periodic returns before. You snap it at 94 and you cut it off at 2023, but on a rolling basis, really strong, right? So on 100% rolling 10-year periods, S&P 600 is outperformed both 94%, 88%. It's really, really strong. And so that persistency and consistency.
Yeah, and I think just to follow on that, Matt, like you're talking about the financial aspect of them. Like when you tease out some of the the ratios between like the Russell 2 and the small S&P small cap, the PE. I know this is average, and some of the outliers can really swing it, but it's double. So it like that is some of the ratios, they're pretty tight, but like price to cash flows is 2 points better, but the PE is double on Russell 2 versus the small cap. So I think that emphasizes your point.
Yeah, and I think also this sort of, again, goes to some education part of it, of like PE, you can't construct a PE if a company has negative earnings, right? So usually the way, data providers calculate those is to get rid of them. And when you get rid of them, it kind of subsumes some of the, if you have a company that has a positive price per share and negative earnings, like they're probably overvalued, right? You're not getting any cash return on that. So it kind of even understates the severity of the valuation issues, even between the two.
I want to come back to this slide, because I would think that there are 2 points that I'd make. In different markets, these factors will have different different impacts, right? You can have a junk rally, and profitable companies may not compete for capital, especially if they're valued. So a junk rally may be good for certain small caps that have momentum, but not good for the overall markets. Do you agree?
Yeah, I mean, I think there's in different market regimes, you're going to have different behaviors. So in 2020 and sort of the front part of 2021, you had this liquidity fueled rally, right? The Fed had cut interest rates because of the pandemic all the way very, very low. There was massive amounts of quantitative easing that was taking place, and there was also massive amounts of stimulus. And it was a very high beta, liquidity fueled rally where, again, real rates were negative. So who cares, right? Just throw your money out the window and it could potentially earn a return. Obviously, when the Fed started changing their policy around inflation and sort of controlling that math, the valuation math changed. So there's going to be cyclical shifts that one benchmark can perhaps outperform the other, maybe on a 6 to 12-month period. But those are going to be cyclical regimes. And what we really are sort of focusing on here is the strategic nature between these two benchmarks. Is that, having that, again, is sort of the old adage of like, don't time the market, have time in the market. Don't time the small cap differences based on different regime business cycles, because that's a fleeting exercise, even within sectors, right? And we talk about sectors, we've written white papers about sector business cycles and how they can be impacted by idiosyncratic events. Even like right now, we're in a slowdown. Healthcare is one of the worst performers. It should, all else equal, work better in a slowdown environment. It's not doing that, idiosyncratic effects. So I wouldn't focus on the cyclical differences, focus on the structural differences that are unlikely to change, that are persistent through time. I mean, that rolling period chart, I think, is really instructive of how these design choices are really impactful on earning incremental returns over a long time period and having that time in the small cap market.
I totally agree with you. And trying to time particularly a small cap rally, I think is crazy challenging, because people can make the case, I think, that a Goldilocks scenario at this point with small caps, underperforming the large cap benchmarks, that under a Goldilocks scenario, small caps might be a place to be, because there you would see an earnings expansion and a multiple expansion. And I think the breadth of the market right now is so narrow that that's where you might be able to get greater alpha. I don't know if Brian, you would agree on that, but that's the challenge, right?
Yeah, that is a tough. I think there's a couple ingredients here. Like that, what you're saying, Matt, makes sense. It's not to try to time like when and where that rally happens, because if you look over the last few years, over the last 23, just since the beginning of 2000, you look at small versus large, and you look at the size factor, but you look at where just small, like S&P is versus Russell. I mean, that's kind of a no-brainer. But look over the last few years, and there's sort of some things in there. You mentioned that time period, late 2020 through 2021. There was a massive surge of small cap ahead of large cap, but it was fleeting, right? And it was like if you're looking for some momentum tells in that, depending on what your time period is, like you missed half of it or you missed it all. But then there's the other side of the coin. Just playing the devil's advocate from an allocator standpoint. There were some periods in 2014, 2015 where I remember we were just predominantly large cap, just because of the way that we look at selecting these things. And it's like one of the things that as an allocator that you want to try to contribute to some alpha on that side, and pick some diversified positions. But they were just a drag in the portfolio. I mean, it was across the board. It was large cap, everything else was out the window. And then you look at the last few years, and everybody wants to sort of believe that and get into that position. It's like even in the periods where the markets were strong, just the breadth was wide. there was some periods where large cap just kept pushing. And a lot of that is focused on the mega cap tech separation. And when you look at some of the ratios on the large cap side, I mean, some of those have gotten a little wide as well. So I'm a believer in the small cap idea. I think when you look at allocators and they're trying to figure out, where and when, I agree. It's hard to time that, but then it's also on the other side of the coin. It's like, here's my benchmark and here's what I'm trying to outperform. So trying to add that alpha, and diversification. And it's like, what's my alternative, right? But I think that, Dan, what you mentioned before about, are we in a scenario where if rates do start to, come off, you get the short end start to come down, but does that happen in a scenario from the macro side? Because that's what we focus on. Is that a scenario where the economy is slowing down, and then all of a sudden you've got pretty tight credit spreads, generally speaking, that even though rates have gone up, credit spreads have maintained or been pretty good. And so if you start to get some separation in those spreads, especially in the high yield side of things, where maybe sometimes the small cap borrowers access, does that put pressure to counterbalance that? I think that's the question a lot of us are trying to figure out at this point. But it's a discussion you have to have.
Agree. You were about to say something, Matt?
Yeah, I was going to agree. I mean, I think the macro environment is, certainly uncertain. And I think if you're trying to sort of game theory out what the Fed might do, right? So if they lower rates, I was talking to someone internally about this, like they're not going to lower rates like 3% overnight, like unless something massively bad happens. They're probably going to do it in a very stepwise manner, very sort of judicious, probably 25 basis at first, just to test the waters. I think it's funny, like a lot of people have probably had careers where they only have ever seen the Fed do something in extremes, like cut rates massively and then start to raise rates aggressively like they've never before. And that's kind of not how they've ever really done it, in sort of like a trying to cool down the economy style. So I think we'll probably go down to 25 basis points. So in that framework, like what would be the reason? Well, maybe it's the economy is doing well, right? Maybe the economy can, with lower rates because they've cooled inflation enough and they've gotten that under control. It's maybe around 2%. And they only need to go down to say 4.75 or 5%. So perhaps the business cycle is starting to rebound. And I think we're starting to see a little bit of that, not earnings growth, but economic growth, continues to be positive. It's, consumer continues to be healthy. A little bit of savings have been depleted, we're definitely not in the savings environment we were, say, a year ago. The big thing for small caps, though, is this funding environment. A lot of the small cap firms, their margins are starting to be squeezed as a result of increased interest expense around debt and indebtedness. And I think that all that means to me is that you should really, make sure that the companies in the small cap arena have that quality bias to them, because we are likely to sort of endure somewhat of a maturity wall within the high yield space. We do know that, a lot of mid and small cap firms, access the junk bond market to secure financing. And we do know that even if the Fed does start to cut rates, those coupons are still, for high yield, they're really elevated. So the financing cost, the interest expense are starting to cut into some of the margins. And we've seen that even just within the large cap space too, where margins have really not been healthily expanding over the past couple of quarters.
Okay, so a question popped up from Eric Connolly, who's always very inquisitive. Thanks, Eric, for the question. He wrote in, relative returns of small caps have usually been linked to the change in credit spreads, either high yield or triple B. Is that also true for relative returns for the S&P 600 relative to the Russell 2000? Eric's always asking twisted questions that are thought-provoking, so go for it. Matt, you want to go for that first?
Yeah, I mean, it was one of the things we didn't identify within the research analysis of, what led to, so on one of those slides, we showed the rolling periods, right? So on a rolling 3-year basis, I want to say it was something to the effect of like 80% of the time on these rolling periods that S&P 600 outperformed the Russell 2000. We didn't sort of regress that around credit spreads. I would say that what we have noticed in some of these cyclical biases, it is in an environment where higher beta is outperforming lower beta, right? More risk on.
Yeah.
So if in that environment, you're also seeing tightening credit spreads, like that probably would be, one of the reasons from it, right? So credit spreads showcase, increase in exuberance and a risk on environment, and that would, in a very, very risk on environment like we saw in 2021, it would not be out of the realm of possibility to see the Russell 2 outperform the S&P 600 because it's going to have a higher beta associated with it, and it's going to be riskier from that perspective.
Yeah, and I think it also depends on where it happens, right? Like in 2014, 15, we had a significant shock to credit spreads from the oil and gas industry. We went from massive amounts of rigs online, cut that by 90%. So naturally, you're going to have some of those start to widen, and that just had a spillover effect on manufacturing, just the general economy. I think right now, one of the things that people should be focusing on is banks and REITs in that part of the market. And I know that there's allocation in all small cap indexes somewhat around the same, but there's this, talk about the wall of high yield refinancing. Like we've got a commercial real estate wall and over $2 trillion of loans on regional and small banks. And what they're talking about is that they compare it to 08, where they sort of, punted things and just, reset and refinance. And, that ended up working out for a while. But the question is, like, some of these banks have tried to offload loans already, and the market is, the bid side is extremely low. So there's unless they have an impetus to sell, why would you sell it at those levels? So I think that if the banks start to get forced to start to move those assets off their balance sheet, I think that would be an interesting. I'm not prognosticating a disaster here with that, but I know that that's a potential issue. And if banks start to get stressed and the economy would slow and banks to get stressed, I think that would be a concern I would probably have, at least on the high yield side. I think you probably see some correlation between the small cap markets there.
I guess, to that point, Matt, well, I just brought up this slide, which I think is important as a distinction between the S&P 600 and the Russell 2000, right? And it is staggering to me on how the definitions are so different in terms of market cap size. Can you speak to that a bit? Because I think that's something that a lot of folks don't fully appreciate.
Yeah, so what this slide shows is that from an active manager's perspective, and there's a long narrative around that there's an increased degree of alpha generation within the small cap space because it is more nuanced, esoteric. There's illiquidity issues there as well. It's less covered by fundamental analysts, and perhaps there's more dispersion within the return environment because drivers are so different. So perhaps there's more potential for alpha generation. And when we're looking at alpha generation, it's relative to a benchmark. And I would say, I think it's something to the tune of like 82% of all small cap blend managers are benchmarked to a Russell 2000 benchmark. And the reason is it's easier to beat. And you see here is that over a 10-year period, 53% of active managers have outperformed the Russell 2000, and the average excess return is 73 basis points. When you change the benchmark that it's being compared to something that has a profitability screen embedded within its construction that also goes further down the cap spectrum than the Russell 2000 does, the math changes. It goes to almost 24% of active managers are able to beat the S&P 600 over the last 10 years, and the average excess return is negative. So I like to think of this as, versus the Russell 2000, active managers are using aluminum bats. It's much easier to hit a home run with an aluminum bat. When you go to the S&P 600, you're using a wooden bat. Much harder to hit a home run with a wooden bat. And I think that's kind of how you look at it. It's just easier to beat the benchmark. So you pick the easier to beat benchmark, and you now have alpha generation that when you use something that's a little bit harder, that alpha is more of a mirage.
I love that. So I've seen a lot of people talking both as active managers, who are launching ETFs, as well as just generally managers, talking about cash flow. You chose to measure things against profitability, and I get that that would be, frankly, easier to standardize. But cash flow for a small company may be more important. What are your thoughts on both cash flow versus profitability, and then active versus passive, beyond just what you just said, in terms of which benchmark?
Yeah, I mean, like the Wu-Tang Clan said, cash flow is everything around me. And I think for small caps, that consists of that too. I think cash flow is really king within the small cap space in order to have, consistent, sustainable returns. And that's really important, right? Because you're going to have cash flow concerns and outlays, interest expenses. So having net positive free cash flow is going to be really important to have a sustainable business that can go further up from small caps to mid caps and then to large caps. So again, having that profitability screen gives you a leg up. I think the debate versus active versus passive, this is a 10-year period, different periods, you're going to have different forms of alpha generation. I think there is still merit to the small cap space for that reason of dispersed returns, less covered by fundamental analysts. There's a little bit of an illiquidity premium there, but that's more when you get into the micro caps. So there is alpha potential in the small cap space. This slide is just meant to show that the alpha that you're sort of commonly seeing is more of a mirage than actually something that is repeatable. And I think it's just instructful to take a more judicious eye when looking at active managers. And again, this is just one screen. We could have looked at a 3-year and 5-year screen. The sort of differences exist. They're not as exaggerated. Here, we just want to really highlight that, over a 10-year period, again, in a 10-year period, on 100% of the areas covered, or the data points covered, small cap 600 beat Russell 2000, right? So this is obviously going to showcase that in a different manner, but it just goes to show you that index construction in the small cap space has a lot of impacts.
You just touched on an important aspect, and I've got a meeting later to talk about liquidity in small caps. So we flesh that out a little bit, in terms of, if there's a fund that is $500 million in market value, we'll say, I don't see a problem with being a small cap fund manager. If it's 5 billion, I guess using like the S&P 600, that market cap size, I don't see it being a problem either. What do you see in terms of liquidity in the way of small caps on the range in terms of market cap size?
Yeah, I mean, liquidity can be challenging. I think that's why, at State Street Global Advisors, we have a pretty sophisticated equity trading team and PM teams to help manage some of those liquidity issues. I think where we sit now, we haven't really encountered those. Also, from an ETF perspective, the basketing process allows you to have a little bit more flexibility on the in-kind creation redemption. We're not actually buying and selling the securities. That is done through the authorized participants and market makers. So there's a little bit of that dual avenue and additive liquidity that the ETF can provide and sort of mitigate some of the liquidity concerns in the underliers. I think when you do step into those microcap spaces, that's when liquidity challenges do persist. Also, if we start to deviate from, say, a market cap weighted paradigm within the small cap space, if you do more equally weighted, you're now spreading capital the same amount over the largest small cap security to the smallest small cap security, and that can have impacts too. So all of those things need to be part of the due diligence process. But again, working with our teams, we haven't sort of encountered significant liquidity challenges managing the S&P 600, just given, again, our capabilities in the space.
Yeah, sorry, Dan, I think you bring up a couple of good points as far as like advisors and, allocators like us are looking at. Like, we look at some of the more esoteric niches in the ETF, or the multi-asset space, like, for example, loans, like we like to use active managers. But small cap, as you mentioned, that there's a lot of value that can be added by being an active manager. But I think you guys sort of, cut right to the chase on this, where you're an index based, but you have some screens that can really contribute that sort of what folks are looking for from an active spot, like right into the index. So I think that really helps out from a diligence standpoint for advisors and allocators. And then, I wanted to go back to one thing before. We were talking about, potential credit issues, down the road. And I think the focus on the financial conditions on the screening for the S&P small cap index could definitely be an additive bonus for an allocation to small caps that should withhold or withstand things a little bit better should there be a credit issue.
Yeah, Matt, just to be really clear, I wasn't pigeonholing a fund that you guys are involved with. I think
Oh yeah.
actually the amazing thing to me is that something like 79% of the AUM in small cap ETFs are in the top 10 funds, right? Meaning the largest funds. And then roughly a third is in 3 of the funds. If I really would worry about liquidity, I would worry about, frankly, those funds than the smaller sized funds. So just be clear. So when I look at small caps, also, I think across sectors. And you mentioned healthcare. Are there sectors that should be doing better these days where there's an opportunity, and maybe this is a question for Bryan as well, where there's an opportunity for more active management in the small cap area? Because that's where you can, it's so inefficient, the small cap area, that you can really gain alpha as a result of stock selection or ETF selection.
Yeah, I think that is probably an appropriate question, Dan, for sure. I did notice looking through the differences between the Russell and the S&P index, and biotech or the lack of biotech and healthcare exposure within this S&P has definitely helped out in the last year. I think the biotech index is down something over 30%. So that's definitely, but that's just part and parcel with your screening process in general. But yeah, I think that, looking at sort of introducing that next component, Dan, and we've looked at this over time in different funds, looking at, especially when multi-factor was a large portion or a large mind share of ours in the ETF space, looking at how managers were screening for constraints within, whether it be regions or within a sector component. For me, I think from when you're looking through an index and you start introducing that next component, that truly takes it to active, because then that really introduces another variable where you could have variation in performance on the upside, but also the downside. So, that's something that we look at and is interesting in how folks slice it up. So I would be curious, as Matt, from your standpoint, have you considered that, or what did you think of that concept as well?
Yeah, I mean, I think the whole due diligence aspect within the small cap space is really important. So, I mean, you had brought up healthcare, right? The lack of healthcare in the S&P 600, and I think that just goes to show you that some of the profitability screen. We also, within our suite, we have an modified equally weighted biotech ETF that covers the entirety of the U.S. equity biotech industry. So it's based on an S&P benchmark that doesn't have any profitability or financial viability screens. And, what we see in that is a lot of mid and small cap biotech firms that are unprofitable. And again, going back to some of my earlier comments, the unprofitability nature of that, quality as a factor, if we just sort of go back to a factor landscape, quality as a factor is one of the best performing factors this year and over the past year. And that goes to show you the power that is being placed on cash flow generation from the marketplace. And so when we go back now to this biotech, non-biotech relationship, part of it is just because a lot of those companies are unprofitable, so they didn't make it into the broader benchmark. And then that sort of screens it out. So all of this is sort of tied and connected together of that, lately that not having biotech has been a drag on the Russell 2000. In 2021, that was one of the reasons why Russell 2000 did well. But those are these seasonality, cyclicality regime biases. And we really wanted to just anchor in on, because, our fund in this space, it's only 3 basis points. It's not meant to be this sort of It can be used tactically, right? Small caps can be used tactically, but we really want to just hone in on the structural strategic asset allocation frameworks, the decisions that if you made in 1994, like, oh, I'm just going to buy small caps, I'll just buy the Russell 2000. Everyone sort of seems to know that, while that choice would have been fundamentally incorrect as you now walk these return paths forward because of these embedded biases. And I think we just wanted to hit on that more acutely.
Yeah, 3 basis points. That's cheap. You're killing me with that number. I mean, how do you, congratulations on offering access to for investors at such a low price. So let's see. So when I'm looking at small caps, I'm always wondering if we're going to see some consolidation in the area. Everybody talks about how private equity has so much money and out there, and you've got reasonable valuations, and yet also for large companies who can issue shares for small companies, I always think that's an opportunity as well. Who wants to take that question? Because I still haven't seen it, and I've been talking about this for a super long time.
Yeah, I guess I'll take a stab at that because I've actually thought about that as well. That what is actually going on that's, I guess, prohibiting some of these strong returns from the small cap. And as you mentioned before, Dan, like right off the jump, that innovation and the economy generates from small companies, and over time, it's generally they get to grow into mid caps and then eventually into large caps, or they get acquired, right? So that's sort of how that happens. But there does seem to be something, and this is anecdotal. Like I'm just going to say that up front, is that you look at the concentration of assets that the largest companies have gathered right now in the last few years. I mean, you have, I don't know how many it is right now, 5 companies that are over $1 trillion. Like I remember 20 years ago, or 25 years ago, where a company got to $500 billion in market cap. There's only 2, right? It was only, I think, GE, ExxonMobil, and then Cisco, and boom, that was the end of it. And so now we have this just large aggregation of assets into the top, and then it happens to be you have this innovation segment right now in AI that usually has all these small things moving around, or when you have an innovative, cyclical thing going on, or secular. And then, but it still seems to be that they've been the ones that have benefited the most from being in that area. NVIDIA, like Amazon, like everybody, because they cater to the large component of the data and everything like that. So it feels like there's I don't want to call it innovation stifling going on, but there definitely seems to be some small coming out. But then all of a sudden, it's like maybe they don't get acquired, but then the top companies will come out with something to compete generally with that. And again, this is anecdotal, but it sort of has that feeling that that's what's been going on. So I'm just curious what you guys think.
I saw Cisco buying Splunk, and that I think was something that was in the works for a fairly long time, and they finally pulled the trigger. But I think, I think it's an example of maybe what's to come. Matt, do you care to hypothecate on this question?
Well, I think a lot of it is you don't really hear a lot of the M&A that does take place from these large firms. So again, this is more just unreported news, but I think Apple has acquired more than 100 companies in its lifetime.
Nobody knows.
Nobody really knows, right?
Yeah,
and some of these are like really, really small, and they maybe offer 1 or 2 technologies that if they're a standalone firm, they'd be awesome, right? You know all about them. You know them by name, by brand name. But when they go into the Apple sphere, they become just Apple products. And 100 companies is a lot of companies. And, so I don't know if it's like stifling the innovation, but more of like incubating it within their own operational process. So, the way you maybe get access to that is just own a tech conglomerate, which is what these are. These are not just mega cap tech firms. They're conglomerates. They offer so many different services, products and services. Microsoft is a great example. We've had people ask us like, oh, what's a pure AI firm? And my answer is like, there's really no pure AI firm. Like Microsoft does a lot in AI, but they do software packaging. They do cloud services. Amazon, same thing. I bought soccer cleats last night off Amazon, but they also have a ton of web storage. They have a TV streaming. So these like tech conglomerates have really, I wouldn't say stifled innovation, but have just brought it more in-house to the extent where we don't really know about it.
Well, I think that's right, man. I think stifling is the wrong on this characterization on that. I think though, when you talk about they've bought 100 companies, it's like those companies never got the chance to sort of graduate through the ranks, right? And I think that is what we're talking about, that investors sometimes don't get that benefit of actually riding that through. I mean, you look at, it's great because these conglomerates can actually nurture that type of business, maybe more so than some of these others, but they don't get the chance to be the standalone. And you get companies like, I think OpenAI just mentioned that they were contemplating they're going to go public at a $90 billion valuation. Like they just skipped 2 steps, right? So it's just hard to participate when you don't get the opportunity, I suppose.
Yeah, and then even look at the name just it completely escapes me, that the semiconductor firm that just ARM, right? ARM was owned by SoftBank. They only issued 10% of the float. And that actually precludes it from being in any benchmark within the S&P, like within the S&P 1500 framework, because you have to have, more than 10% of your shares floated. But again, that's sort of, that's a very closely valued company that now is only offered to a very small amount of investors. And I think that's also a model we've seen play out, more recently as well.
Can we hope for the IPO market to open up then?
I mean, part of that's the rates, right? Rates, financing is a lot more expensive. The, balance sheets are a lot more expensive right now. And I think the IPO market is probably, a little bit harder to crack, than it was maybe a few years ago when real rates were negative. And I think, again, that goes back to, some of the innovation concepts too. And, perhaps it's just easier to be a private company, just given what regulation has to say as well.
I'm going to be an optimist and take the other side of that, because capital is still required, right? And nobody wants to borrow as a small company at 15% or some, egregious level, right? So at some level, you take the shot because you're forced to, and grow through, issuing shares, maybe through a smaller firm, right? Maybe I'm not talking necessarily about a a $50 billion firm. I'm thinking more like a firm that is 300 million, 400 million, 500 million market cap size that can come public through a smaller issuer. I want to see that. I don't know if I'll end up being right, but these small companies still need money to grow, right? And if they bring the innovation, maybe the capital markets will be friendly. We need it.
Yeah, I mean, that was kind of the SPAC boom, right? In 2021, 2022, and that kind of busted.
Please don't bring that up again.
Yeah, that was an ouch.
Yeah.
But but the SPAC, that was a whole different situation to a certain degree, because, well, that was a new form of capital access that I don't think will be repeated. Just to be really clear,
it's funny because we dealt with that in, what was it, 07, 06 and 07, and then it reared its head again, 10, 12 years later, and I thought that it would take at least 20, but it came back quickly.
Yeah. By the way, now that SPACs that are just sitting on treasuries might be a good small cap opportunity as they divest from being a SPAC and they just become, well, anyway, that's a whole different discussion that isn't really relevant here. So, we're getting to the top of the hour. Bryan, let me present the question to you. If you're optimistic about the economy, how do you position yourself for small caps?
So that's assuming I am optimistic about the economy.
How to set you up.
No, I hear you. I've gotten a little more optimistic in our models and how we look at that. But we look forward to the economy sort of getting into a point where it's broad in distribution, right? So I think right now, the way that we look at the world, manufacturing has really lagged. Consumer side of things, the services index, they've been They're still above 50. They're still in expansion, but they're not fantastic. We talked about the consumer, how they're holding up. They're depending on measurements you look at, revolving debt has gone up substantially. And those are sometimes harbingers for, challenge in the small cap side of things. However, if you do start to see, if we are able to get into a point where we don't need to get the Fed to necessarily tell us that they're going to be lowering rates. We just need it to get to a point where we're at a point where we digest it, and we think that the next move is down, right? So we don't need them to necessarily tell us that, because the 2-year tends to lead Fed funds rates down anyways. And if we can start getting some regression in the short-term rates just from the treasury market, that would be a positive sign. And I think if that is coordinated with an economy that's able to sort of skirt by this potential slowdown, and we don't get hammered by rising credit spreads, I think that's an area where you can start to get some benefit from being diversified finally, like being away from mega caps and being into small caps, things like that. Like, I think I would like small caps more than even mid caps, because I think that if you are to start to get some relief and you don't have credit spread issues, I think that's a nice spot to be in for small caps. So that's what we would be looking for, is that some stabilization in the economy, maybe a pickup in some other sides like the manufacturing, just to see some coordinated growth in the U.S., but also get to a point where rates are stable, and we can start to see that the next move isn't up, might be down. I think that's what we would need to see.
Yeah, by the way, we didn't talk about the dollar, because why? The dollar doesn't really impact small caps, right? And so it may be a place to hide from that kind of volatility. I don't know, Matt, if you've done any work on the small cap dollar influence on small caps.
I mean, they are more domestically oriented, so they're going to have a lesser relationship to movements in the dollar. But it's on a company by company basis sometimes. Like, what's their supply chain look like? If they're financing from if they're importing a lot of their goods, that can obviously be a benefit when the dollar is stronger, because it costs less dollars to buy weaker foreign priced goods. But they are more domestically oriented, so they're going to be less impacted by some of the fluctuations in the marketplace. In terms of like the actual significance of the returns, we haven't really looked at that. But I think if you gonna sort of take a stance around the economy is going to be held up by the consumer, they're more domestically oriented, consumer oriented. Small caps could potentially do well in that type of environment, irrespective of the dollar's movement.
Yeah. Dan, I actually went down that journey the other day to sort of look at it, just to get an idea. And over the last 5-ish years, there's been about a negative 0.5 correlation between the dollar and small caps. But you go back over 20 plus years, there's zero. So I think that that's all explained away by rates over recent years, because I think with rates moving up, that just hasn't been good for small caps.
So I guess I'll conclude with a question to you, Matt. Thanks for challenging the active managers, right? I think, frankly, too many times the active manager takes the easy way out, and they should be using, as a financial advisor, should be using as a benchmark an ETF, right, to compare to their active managers. I think, especially at a 3 basis point fee, right? You've got access, transparency, and the integrity of a true benchmark that you can invest in, right? So great work on your white paper. I hope a lot of folks will read it and learn more about it. Any further thoughts on that?
No, I mean, like I said, the paper was really to help with benchmark selection, just understanding the differences around that construction, the choices that can be made, and the lasting impacts that can have on a more strategic basis, because those factor premia that the small cap benchmark for the S&P franchise leans into, quality and size, can potentially add those incremental returns over a long time period, irrespective of cyclical shifts. And I think that's what we really wanted to highlight, is that these are not sort of fly by night decision choices that have led to different returns. these are persistent and consistent, and you see that in the rolling analysis, the factor analysis, and even just obviously the cumulative as well.
Gentlemen, thank you very much for spending the time with me. Matt, thank you to State Street Global for sponsoring the call. I look forward to Goldilocks coming out someday, and we'll all be better off if that happens. Have a good day, and thank you again.